How broadly does it stretch? I mean, certainly it's gotten FX traders' attention. Does it affect investors otherwise?
Well, here's the thing. A lot of focus on how much currency volatility has spiked in the last year. If you look at J.P. Morgan's FX volatility index, it is at the highest in a year. But a lot of the charts that I've seen only go back a year or so to show that spike, where if you look at the long history of currency volatility, J.P. Morgan's, I think, goes back to the early 1990s, we're not even at the long-term average. So, yes, it's been a short-term spike, but we're still relatively suppressed. If you look historically at when we've gotten these short-term spikes in FX volatility, in terms of the implications it has for other asset classes, in the case of the S&P 500, so the U.S. equity market, which is my bailiwick, only once in, I don't know, maybe 15 or 20 occurrences, similar to what we've seen recently, did the U.S. equity market suffer a big loss. So in general, the U.S. equity market tends to do fairly well. EM actually broadly has tended to do fairly well. And you've also tended to see a drop in overall equity market volatility. So this assumption that this spike in currency volatility is going to automatically mean consistent weakness and spikes in volatility measures across other asset classes, history does not suggest that's the case.
There are some things that can be argued that are different, Liz Ann, and one is the stronger dollar that we've seen kind of finally kicking into gear, that flat yield curve, and the Fed continuing to hike as we see disengaged central bank reactions now. When do you expect investors to have to rotate into safety, like utilities, like value, versus the growthier cyclical stocks?
Well, we've actually already started to see that. You've seen bouts of outperformance by some of the risk-off asset classes and a move toward more defense within the sector level and that shift toward value. It's not been persistent yet, but I think it may be a sign that we are at or near an inflection point where, given late cycle tendencies, the fact that inflation is picking up, growth may be slowing either because of the tariffs or just in general because of the spike in growth we have seen in the kind of waning of some of the short-term benefits of fiscal stimulus. So we've had sort of a more defensive outlook, and we've been citing some of the increasing risks. I think this kind of adds to the pot of increasing risk. We don't think the secular bull market is sort of dead and buried, but we do think that this is an era where we're likely to see more bouts of volatility and probably greater risk for investors.